Hey y'all, this is Ryan with TrendLizard.com. I hope you're having a wonderful day and staying healthy both physically and mentally during these crazy times. I put out a video about a month ago, right when the coronavirus crash started. I wanted to provide an update on that with what's happened with the Elliott Wave pattern since then. Obviously, a lot has taken place. Initially, we saw a significant follow through to the downside, and then off of March's low, a very sharp bounce back that's taken place that we're still in now on April 13th of 2020. So I wanted to do an update and show you what the impact of this action has had on the Elliott Wave pattern and what it means going forward and the thought process that we're going through to try to figure out what's coming next. So that's the biggest priority that we're going to do through this video. I've gotten a bunch of kind of subscriber comments and requests from people who follow this YouTube channel that have asked for an update, so I'm glad to be able to provide that for you. I also want to remind you that we offer a service where we update the market and the Elliott Wave pattern on a day-to-day basis every day the market's open at TrendLizard.com. It's not expensive, it's pretty cheap. We offer a very good service, and we teach you how to use the Elliott Wave theory day in and day out. So please come visit, take a look. We have a free trial, all that fun stuff, and hopefully it's something that suits your needs. But in the meantime, I'll provide this update, kind of go through a whole bunch of charts to show you what we're thinking, and go from there. So get comfortable. Let's take a look at some charts. Here we go. All right, folks, so one of the first things that I want to do is show you one of the things that drove me to Elliott Wave theory in the first place. And sorry for starting off with a diversion, but I think it's important, especially right now. Unfortunately, I've had enough time to kind of mess around on some investment message boards out there. It's normally a fairly toxic and dangerous place for people to go. But anyway, it blows my mind kind of how many people out there feel like if they see something negative that's happening in the world, that it should translate to tomorrow's price action in the stock market. That's just not how the market works. I mean, I know it's almost a joke at this point saying it's priced in when you see things happening, say, for example, a really high unemployment or jobless claims number. And then you see the market rally the next day, and people are just kind of flabbergasted about that, expecting their puts to print and things like that. And unfortunately, that's just not how it works. And I think that's what drove me to the Elliott Wave theory in the first place, is trying to figure out what really makes the market move. Because if you're looking at headlines trying to equate that to what's happening on a chart, it rarely syncs up, and it's super frustrating. You're going to be out of this game really quick. And even worse, then you start having hope and expectation for what the market should do, and then you start actually filtering the information you see to try to make it fit. And if it's on the bearish side especially, you have people that are starting to kind of root for negative things, and it's an awful process that people go through that I've seen. And a lot of it happens in the Elliott Wave theory. I've seen it when you create an Elliott Wave count and you start thinking the market should do something based on that Elliott Wave count. You start trying to force everything into your expectation of what should happen with the Elliott Wave count. It's just not how it works. We're here to listen, not to open our mouth and tell the market what should happen. We're here to listen to what's going to happen based on what the market's telling us. I just want to show you a couple examples of that. One, this is the date in May 2011 that Osama bin Laden was killed. This was a big thing at the time. It may seem like a small thing now, especially with what we're going through, but we had this massive up move that we were in. Literally, the day that he was killed marked a high that lasted nearly a year. You know, I don't know if you want to equate those two things, but if you knew the fear that people had back then, worrying that there was going to be other terrorist attacks, and to think that the day that he was caught, you think that would be a pretty joyous occasion for the market, it actually marked the day of the high that turned into a major 30% decline and took over a year to recover from. But it works both ways. Some people may remember this. This was September 11th, 2001. Obviously, that happened on September 11th. After that day occurred, that awful tragedy, the market closed for a week. The market went down for 5 days and reversed and went higher substantially for several months after that. You would have thought, if you would have known beforehand, kind of some insider trading, that if you knew the Twin Towers were going to be attacked and America in general attacked, you probably would have been thinking this is a great time to buy some short side positions. Well, it would have been for 5 days, but the market would have reversed for there. It doesn't always sync up. I think that's the point that I'm making here. So please don't try to impress what you think should happen based on the headlines onto the stock market, because you're just going to not have a good time. So with that out of the way, I want to dive into what is going on right now with the Elliott Wave pattern. So here we go. I think the one thing that's obvious from what's happened over the last handful of months, couple months, really. It's all happened so quickly. It feels like a long time, but it's really not, is that the bull market's over. The advance off the 2009 low is absolutely over. I don't think anybody can question that with the size of this move, and I'll show you a couple things that kind of flesh this out a little bit more. This chart here is a log scale chart. It's kind of hard to tell how big this move is, but when you put it on a linear scale like this one, you can really get a good idea of how deep and strong this move has been. I mean, you're talking about 11 years or more or less of advancing movement, followed by a few weeks of action that retraced 50% of this entire advance on Russell 2000, the small caps. So this gives you a good idea of just how big the decline has been and how clear it is at this point that the bull market is over. And that's something different than what I had originally thought as the pullback began. And I'll kind of show you why that has changed over time. So I think the thing that we need to ask then is if the bull market ended, when did it end? Did it end in 2020 or did it actually end in 2018? And I think there's a pretty good case that can be made that it ended in 2018. This is still the Russell 2000 chart. You can see that it never set a new high. The high that was set was in 2018. You see this pullback, a three-wave move here. You see this recovery in 2019 that was a three-wave move, and then a sharp decline from there. So I think the case can be made that the high to the bull market actually happened in 2018, despite the fact that the market continued higher to new highs on the major indexes like the S&P and the NASDAQ and things like that. But the more things we look at, I think it's an easier case to make that it actually ended in 2018. Here's an example. This is Japan. 2018 is the high here. You see you had that three-wave pullback, three-wave advance in 2019, and then a sharp pullback in 2020, obviously. The bull market did not end here for Japan. It clearly ended back here in 2018. We follow 40 different ETFs at TrendLizard.com, and I go through the list, and more than not are ones that look like the high actually occurred in 2018. This is valid, and I'll show you why as we go, but some of the ones that are coming back are Russell 2000, transportation, emerging markets, India, Canada, Germany, Japan, Singapore, United Kingdom, Brazil, China, Russia. As far as market sectors goes, biotech, telecom, energy. There's a long list of ones that put in a high in 2018, were never able to get back above that high, and the move that happened in 2019 is a three-wave move. I mean, you put it all together, and it's pretty easy to make a case that the bull market ended in 2018. So let's transfer this to the S&P and see how that works here. There's two ways that you can look at the S&P 500. One, you can say, okay, the five-wave advance off the 2009 low actually ended in 2020, despite the three-wave advance that took place in 2019. Or you can take a look at it and say it actually ended back in 2018. We've had this funky kind of expanded move since then. Now, it's very important. If you conclude that the high happened in 2020, and what's happened since then is we've had this sharp down leg, there is no way that this pullback has ended if we conclude that the high happened in 2020, or if that's what actually occurred. If it happened back here, there's a possibility that we had an A down, a B up, and then a C wave down to complete the move. But we'll get more into that, but I think that's an important distinction from what we're seeing. And when we look across the charts, the conclusion that we're coming to is that the bull market ended in early 2018, and everything since then has been part of a counter trend pullback. So let's continue to dive in here. There's two possible labelings then if we can come to the conclusion that the bull market actually ended in 2018, which we have. The first conclusion is that we've been in a large three-wave ABC pullback since then, and that the pullback actually ended at the 2020 low in March, and we have now since resumed a new uptrend. The other possibility, the other way you can look at this, and this is kind of a problem with counter trend moves, is you never know for sure, is that instead we have completed a three-wave pullback, which is only wave A of a larger ABC move. So we'll see some more chopping around here, followed by another big, huge down move that ultimately completes the correction of the big bull market advance that we believe ended in 2018. So that's the debate. So how are we going to determine which is the case? Do we know if the bull market or if a new uptrend has resumed, or if we're just in some large B wave that's going to give way to a large C wave decline before it's over? So that's what we're tasked with. I'm going to show you our thought process as we go here. The first question that we have to prove is that the 2020 down leg is over. And we believe it is. We believe the recovery that's kind of sprung off of March's low is a recovery effort. We don't know what form that's going to take yet, but we have some ideas as to how we will determine it. So first, I want to show you why we think that sharp down leg is over. If you take a look at QQQ, you can see that it's impossible to call this an incomplete down leg, because this recovery here, if you tried to call it a fourth wave within an incomplete 5-wave decline, you can see that it's overlapped with wave 1's low. That can't really happen. Plus the size of it, it's so big, there's just no way you can consider this part of this same down leg. So we have to conclude that the down leg is over. Another way that makes us more comfortable calling the down leg over is by looking at some of our indicators. This one's the bullish percent index on the NASDAQ. This big decline here was what took place in February and March, and we've had this huge recovery in this indicator off of the low. This does not look like some corrective move within an ongoing down move. We're pretty confident that the 5-wave down move ended, and let's take a look at that. So here's that 5-wave down move in February and March. Since then, we've seen a recovery effort, a very nice recovery effort. It's retraced about 50% of this big sharp down leg in February and March. Now, the thing that interests us the most is the nature of this recovery so far off of March's low. You can see it is a 3-wave move currently. No question about it. You can look at any chart you want. It's very clear it's a 3-wave move. If this move reverses back down at any point in time in the near future, it's going to be a bearish thing. We have this 5-wave decline here, and then we have a recovery. If it proves to be a 3-wave move, that means we have a trendy move followed by a counter trend move, which can only mean we're going to get another trendy move to the downside at some point. If that was the case, we would have to think that we are in a larger ABC move. We just completed wave A, and this move here that we've got, if it becomes corrective at any point, we have to conclude that the down move is not over. So even though we're looking at a short-term time frame here, it is super critical what happens from here. If it at any time, whether it's now, 2 or 3 months from now, if this recovery proves to be a counter trend move, again, it can only mean that we're still in this decline and that things are bearish looking forward, and that we're going to get at least one more down leg. If instead we can avoid turning this into a counter trend move, and this can turn into a trend, and this turns into a trendy 5-wave move, then we're talking. Then it's possible that a major low is already in, regardless of our impression of what's going on out in the world, or what we think should happen, or the fact that the economy is shut down, whatever else. It doesn't matter. If this thing stays trendy, then the possibility that a major low is in will exist. And so here's some actionable items from here. The SPY needs to stay above 257. If it moves below 257 at any point, this becomes a counter trend move. The equivalent level on DIA is 219, and the equivalent level on the triple Qs is 188. If price moves below those levels at any point in time, it means that this recovery is a counter trend move, and we are still going to continue this pullback from here, and you'd have to expect significantly lower levels from there. You can be bullish on the market as long as we stay above those levels, but the second that price moves below those levels, you have to realize it's a clear indication that we're staying in this large pullback, and there's going to be some pain ahead before this is said and done as we continue to correct a multi-year bull market advance. One last thing I want to talk about. The recovery that's going on right now. This is pretty near-term stuff to be looking at for this video, but I want to show you anyway, just because it's just an interesting study in Elliott Wave here. So obviously we're in this kind of recovery that's 3 waves up currently. Hopefully it turns into a 5-wave move, but it points to a certain area that you need to be watching to see as a possible area for a high. So the 200-day moving average on the S&P 500 is at 298. A 61.8% retracement of this entire down leg occurs at about 296. I can't remember the exact number. And at 289 is where the current up leg in April becomes the same size as the up leg in March. And that would be a pretty interesting area to watch. 289 up to 298, where we could potentially get a high for this up leg. If it's a counter trend move, I would keep an eye on it. We'll see what happens from there. Well, I hope that's helpful to y'all, folks. I just want to show you the objective approach that we're taking, taking everything into account, what makes the most sense when looking at the Elliott Wave pattern, and figuring out what it means for the future. So I think it's a super interesting point right now. We have a near-term level that looks like it can impact the long-term direction of the market. So I advise keeping a close eye on those levels and going from there. So please come visit us at TrendLizard.com. We're working hard on this stuff, and we can make it a lot easier for you to understand as we go. So have a great day. Come visit. We'll talk again soon. Take care.